the Real Estate Players Podcast. Real talk, real players.
Welcome back, guys. Today's guest, we have Nick DiLeone with DiLeone Real Estate Partners. Welcome, Nick.
Thanks for having me, guys.
Good to see you. What's going on in your world? Tell us what's the latest.
Latest was cold plunge in 20-degree weather this morning. So doing this cold plunge challenge, and I hate the cold. I'm not a morning person, so the biggest thing is the mindset, right? Jumping in that cold water when it's really, really cold and just like looking at that pool, dreading it. It's a big mindset shift. So
does it work better when it's cold outside or when it's hot outside?
Yeah, I don't know. The water was only it was like 50 degrees. So it's actually warmer in the water than in the air. But I think the water is going to start dropping because we have this weird Texas weather, right? It just fluctuates so much. So I think later on in the week, it's going to be really hard.
Yeah. So you don't like refill it or anything. You're just like keeping it and like whatever it is, it is.
Yes.
Oh, fun. Yeah. People think I do cold plunges because, the nutrition business. I'm like, no, I appreciate you guys doing it. But one thing I find that a lot of us like GPs or operators have in common is we like to make ourselves uncomfortable. So maybe that's just one of our weird niches of like, hey, what can I do to make today tougher? I think this is what I'll do.
I guess it's hard. It's hard being an entrepreneur. That's why, right?
Yeah.
Yeah.
I mean, and you've been doing it for a while.
You said it was part of a challenge, right? That you're doing for this year?
So basically we do these health challenges, right? So we have to work out for 30 days straight, put $200 in a pot if we don't check in. And then at the end of 30 days, we take the money and we give it to a server, which is always great. This time we switched it up a little bit and we're doing this cold plunge challenge. So, there's some guys in California that are doing it. It's a little bit easier for them. Right now in Texas, it's pretty challenging. But it's always great to kind of give that. So a lot of times it's like $1,000, $2,000 to give that to a server. It feels so good, and they're really appreciative.
How often do you do it? Like per year?
Usually it's once a year. We did one in the summer, so it's twice a year. So once or twice a year.
It's actually a really cool activity that I feel like, I can make James do it. Yes, he loves when I make him uncomfortable with my "that's what she said" jokes. Poor guy. Okay, I love that. But
cold plunge.
Nick, you launched DiLeone or Leone because I kept saying Leone. I'm so sorry. When did you launch it?
So we moved from California about 5 years ago, the Bay Area, and we launched it through COVID. We came here and COVID hit a month later. Like, we were so blessed to have moved to Texas because I'm originally from New York, California. All my friends were on lockdown and we were like, that's a hoax. We're just going to keep going, doing things. And the business was strong, right? So I just launched the syndication business through COVID.
Wow.
I didn't realize, I forgot that we were both New Yorkers. So, but glad to have you here local now.
Nice. Very nice.
Do you say pecan or pecan?
I guess pecan.
Thank you.
Pecan.
Northeasterns. Yes.
Yeah.
What? Joe, that's not okay. I've already asked James this question, and he's normal. So what are the newer projects? What's going on right now? I know that we had a weird couple of years. I mean, I moved to Texas and started syndication, I don't know, 2021, 2022. So I understand that aspect, but Texas is always fun because there's always something going on no matter what's happening in other states. But I know you are doing a lot of work. So I want to hear what projects you have going on.
Yeah, so we started out in multifamily. So I've been in commercial real estate for 20 years, worked at some big institutions in New York and San Francisco. So that's kind of my background, mostly asset management. So I was an asset manager at Nuveen Real Estate for 15 years and then headed up asset management at a value-add industrial shop for 2 years in San Francisco. So that was always my background. Right out of the gate, didn't want to compete with my partners in the industrial space, so moved into multifamily. And it took a while to get our first multifamily deal as kind of the lead GP. I've done other kind of like support roles, raising capital, asset management, consulting. But we bought our first kind of official deal that we're kind of hands-on in Waco of September 9th, 2021, right before they started raising interest rates. And that was kind of a crazy story because it was a light value add. And at the time, everyone wanted value add. So I know a few syndicators kind of in the syndication space that skipped over this deal in Waco because there weren't enough units to renovate, right? And we kind of dove in deeper, kind of brought in some our institutional kind of thinking and said, taxes haven't been protested in 2 years. Insurance hasn't been bid out. Rents haven't been pushed. We went to the property manager's office and she had a little Post-it note to remind her what the rents were by unit type. And I'm like, what's the last time you updated that thing? She's like, it's been about a year. Like, it's because it's hard to push rents.
I heard about this deal. Like, I heard that you guys kind of knocked out of the ballpark right there, because I think it's like you kind of noticed what other people weren't noticing, and then you're like, oh, opportunity.
we just looked a little bit contrarian, and we were like, we think we're underwriting this thing pretty conservatively, but we're going to get good returns, and we're not going to have to do the typical heavy lift that a value add requires. And yeah, we just sold it in May for a 23% IRR and a 1.7 equity multiple. And again,
and how many months or years?
2.5 years, 2.5 years.
Mm.
The key with that in all our deals, because we're very conservative coming from that institutional background, fixed rate debt. We have 11 deals as a GP. This one that we sold, some of them are RV parks. We pivoted into RV parks for a little bit, mostly multifamily. And we didn't feel comfortable taking that risk on with the floating rate bridge debt. And as much people say that no one knew the Fed was going to raise interest rates. Me and my partner at the time were like, the Fed is saying they're going to raise interest rates. No one thought they were going to raise them as fast as they did. We do not feel comfortable doing floating rate bridge debt because this is a risk. We didn't think we were going to raise them this much, but this is a risk. So we bought that Waco property. We tried to sell it 3 months later because it was a fixed rate loan assumption. We bought it for 61 a door, and we saw comps selling for 120 a door in Waco in 3 months. So we're like, let's sell this thing before they start raising interest rates, because they told us they're going to raise interest rates. And we had it in contract, and they started raising interest rates, and the guy kept retrading us downward. So we're like, and it was a really good price. We basically, let's take it off the market. Let's let the market settle. And then we brought it back on the market last summer and sold it.
Yeah, I mean, I as much as I was like, wow, I got into this at the wrong time, it was actually kind of like the right time, because you're like, oh, now I see what could have possibly go wrong. And then you're a little bit more conservative because you're like, I can see all the problems that arose and I want to be careful moving forward. So it kind of makes sense. And I mean, you had that background, which is helpful. I can't even imagine having that floating rate and getting into that mess that some have gone into. I feel so bad for some people, because, there are good operators that get in, the shitty situations. And then you're like, the bad operators, you're like, yeah, F you, but I feel bad for your investors. So, I mean, you have the torn empathy a little bit, like learn your lesson, but like don't on people's hard-earned cash, like,
that's right.
It's a tough game. It's a tough game.
Yeah, I think the last couple of years separated the men from the boys, or however you want to say
it. Yeah.
But I think you have another one. You probably can't mention it yet, but congrats ahead of time.
Well, so that's I mean, it's something we can talk about. The capital raise now, and I will say this. So I have I had 3 deals under contract. So we just pivoted back into the industrial space. We had 2 triple net single tenant deals under contract and a multifamily deal. And we can talk about that deal. And I went in, I was like, you know what? It was easy to raise capital before. I'm going to raise capital, no problem. And big punch in the gut. No matter what your experience level is. I mean, there's a guy, Brandon Turner, right? Beardy Brandon. He goes on Instagram. He used to raise $100 million just going on Instagram. He's having trouble raising capital. So I was like, I can do this, no problem. Lesson learned, don't get 3 deals in the contract at the same time when it's hard to raise capital. Very
Yeah.
not a good move.
Uh,
That was a mistake. That was a mistake. And this is how you grow, when you learn from your mistakes, right? So we let one of the deals fall out of contract. There were some issues with that deal, but the other 2 deals are both in DFW, and the capital raise is just hard right now. It's just hard because, and I'm running Facebook ads on both these deals, the multifamily deal and the industrial deal. I'm getting 2 to 3 times more clicks on the industrial deal versus the multifamily deal, because I think people have been burned by multifamily, right? Floating rate bridge debt. Honestly, I'm in a deal right now that has, as an LP, at a floating rate bridge debt. I assumed they had a rate cap. They didn't get a rate cap, and that deal has been in trouble. But I think they're going to do a cash neutral refi with a PFC. It's going to save them. So even experienced people make mistakes, right? Make assumptions. I made those assumptions. So this capital raise is super, super challenging with these 2 deals. The industrial deal is almost full, I think, because people think it's like, it's different. It's a new shiny object. It's, and it is a really, really good deal. It's getting better by the day, kind of more data that we get on it. But the multifamily deal, yeah, people just kind of bucket you into, like, I got burned with a floating rate bridge multifamily deal. I don't want to look at that. I don't even want to think about it psychologically. When we signed the LOI, rates were kind of at the bottom in September. Everyone thought the rate decreases that the Fed was doing was going to lower interest rates. And ever since then, they've gone up. So thankfully, my fallback plan was that this is a loan assumption. You could do a loan assumption. I was going to do new debt. So we fell back to a loan assumption. So it's very similar to our Waco deal. It's like a light value add. A lot of people don't like 60s product. I think this is the time to move into 60s and 70s because everyone's moving away and the cap rates have increased, because DFW arguably is the #1 multifamily market in the country, right? Because the population growth and job growth is just off the charts. We're supposed to be the biggest city in the country by 2100, right? Projected. So I do believe that you should be leaning into C class right now when everyone's, just contrarian view, moving, kind of leaning into it. But hopefully, Joe, to your point, hopefully we get this deal across the finish line. We can finish the capital raise. We have a few big check writers that are looking at the deal that can close out the raise. But that's a very big challenge.
Yeah, I'm in
I
several
think some
bridge
people
deals
want.
that.
Oh, sorry.
Yeah, I'm in several bridge deals that are same situation, that you're not really getting your cash flow the whole time. You don't know if the equity is going to come back. They're working on refinances. So a lot of people in the multifamily space have had their money tied up these last 3 years. So we need to bring new investors outside that haven't really invested in multifamily before, while we unlock some of this capital the next several years as these deals trade out. Is that what you see in the multifamily space?
Yeah, so running these Facebook ads, that's exactly what I'm seeing. The people that are clicking on the multifamily, they're like, I've heard about multifamily. I'm thinking about it. Let's talk about this deal. It's interesting. DFW is a strong market. Where I think what's happening is the people that are not clicking the multifamily just saying, hey, look, I don't want to touch this thing with the 10-foot pole. If you structure your debt right, and pretty much, I don't know what you're in the debt space, James, so you see more of this. It feels binary. Like if you put floating rate bridge debt on your deal is not performing well, even if you're operating it really well. Maybe you have an interest rate cap, and then also the looming maturities, right? They have to kind of recapitalize the deal potentially and kind of pivot into higher interest rate loan. That kind of makes it challenging too, right?
Yeah, the bridge debt was originally supposed to be for deals that couldn't get agency financing. So it was like 60% occupancy or an inefficiency. It doesn't qualify. Use the bridge loan, get the occupancy up. But what happened was it got so competitive, people were just using the bridge loans to buy like a 95% occupied, stabilized deal just to get the price up. So that's kind of what happened.
Me and my partner would talk about this all the time because he was a lender. He was a lender at Citibank and Starwood. Like that's the purpose is to bridge to stabilization. That's why it's called a bridge loan. And we're like, we would only bid using new Fannie and Freddie debt or loan assumption. We kind of put it out there like we like loan assumptions. And we were just getting crushed in our bids. But we're like, we just do not feel comfortable taking this risk because it could have, if it continued to go up, those deals would have been okay, right? And interest rates stay low. They would have been fine. We just didn't feel comfortable taking that risk. It just seemed they were bridging to nothing. You know, they weren't bridging to stabilization. They were already stabilized. Didn't make sense.
Yeah, and a 1.7 equity multiple in today's market when a lot of people are getting 0x is amazing. So congrats
also
to you
too,
guys.
you usually aim for 2x in 5 years. That's definitely above that ballpark.
Mm-hmm.
I mean, to your point about investors liking industrial, I mean, like I'm in a development deal right now, and I'm seeing more pull on that than in a multifamily. I think multifamily had a lot of bad rep last year with the big news stories. Okay, so you get people fearful because of that. Second, too, is I think there's some type of understanding that people have. Oh, I can understand how single homes work versus the multifamily. If they're not used to multifamily, they'll understand the value add concept and how you're buying net operating income. You know what I mean? Like that whole concept. Sometimes they can just wrap their mind around like industrial or, you know, residential homes a bit easier. You know what I mean? So I think that's what I'm starting to see with my investor base. It's like, oh, that makes sense. Trying to sell a home at this and building it for this. Like, yes, that makes sense. You know,
And we see it. I mean, you run a meetup. You guys all run meetups, right? So you see there's a really experienced people that come to meetup, and then there's like kind of entry level, kind of just getting in. A lot of those entry level people start with single family homes, and I think they start to understand that, you know, it's hard to scale, right? You have properties kind of all over the place. It's hard to scale. That's kind of the pitch why multifamily makes sense. I always tell people, like, don't feel like you need to scale some big single family portfolio because that feels comfortable. And you talked about like being uncomfortable as an entrepreneur. This is super important. Move into the multifamily stuff much faster than you think you need to, because I've never done the single family stuff before, but my former partner did. He had a bunch of in Miami. Just move into it faster, and there's a few ways to do it. Just move into it faster, even though it's uncomfortable, right? You could attend meetups and like partner with people and find experienced people, right? You can join a mastermind. I think we're all maybe kind of tangentially involved in masterminds. I was part of a mastermind, so you find experienced people to kind of leverage their experience, or you pay to play. You invest in some GP's deal as an LP. And hopefully you find some, like I always kind of offer this to my LPs. Like I like helping people and teaching people. Like if you invest in my deal, I'll maybe let you attend one of our property management meetings, right? Kind of learn that right that way. And I'll take you under my wing a little bit. So that's kind of 3 ways to get into it. Don't be scared if you're new, you know, because I own a few single family. I don't want to get into multifamily. It just seems overwhelming. Like you said, it is more complicated. But you join a community, you listen to podcasts, you kind of educate yourself, and you get over that fear by kind of partnering with experienced people.
funny you say that because that's exactly how I got into it. Like everyone I talked to were like single family, multifamily. Like I was like, well, yeah, well, I'm a business owner that like loves risks. So I just kind of jumped 2 feet in, started a meetup without really anything under my plate and just started connecting people and doing it that way, meeting people. And then that's how I got into a bunch of deals. Like I do meet a lot of people that start the single family duplex squad and then build from there. And I'm just like, well, let me jump right in. But sometimes it works, you know what I mean? I mean, if you can at least trust people. I mean, my problem was not vetting people. So now I have a PI, which everyone knows now. Like if you partner with me, you're gonna get vetted. I'm so sorry, but that's just how it works. But again, it's like you can only do so much with looking at people's backgrounds. So you have to like kind of have the similar morals as well, understand their integrity. I have a really strong gut. So right now I pull with my gut too, but you know, understand the deals 100%, but also understand who you're partnering with. And then you'll do a better job.
I have a principle that I am not as good at vetting people and partners. So I always involve my wife. I think generally, and this is a generalization, but generally women are more intuitive than men.
Yep.
My wife is always involved in vetting partners. Because I'm like, this, you feel so good. It's like, yeah, this person's great. Let's go. You're an entrepreneur. And I'm always kind of like thinking the positive of everybody. That's a strength and a weakness, right? And my wife is the opposite of that. She kind of yin yang is the whole thing. But that's super, super important. Like when you're vetting a deal as an LP, GP, vetting that GP is so, so important. That's like the most important thing. And like you said, values aligning, like how does that person address difficult situations? Like how are they
even like how do they treat tenants? Like even like the borderline, when I saw someone how they treated them, I was like, oh, okay, that taught me a lot, like instantly. And I didn't do good vetting the first year, but my husband and I were business partners and have been for a decade. So like he is usually the more negative, but like more realistic, and I'm more usually the positive. But I do get that strong intuition. So I definitely feel like I think our business with helping clients around the world has really helped me over the years with this, because I've had people surprise me over the years where I thought they were great people, and I'm like, oh, that one kind of hurt, right? So now it's like I think that taught me a lot about my intuition and learning like to listen to it a bit more. But yeah, sometimes when I get really excited about deals, I'm like, Chris, talk me off this ledge, and then he's like, okay, come here. I'm like, okay.
That's exactly right. To your point about talking to Ted, it's like if you go out to dinner with a partner and you see how they treat the waiter, right? Are they like a jerk to the waiter, or are they treating everyone kind of equally, right? And being more down to earth. Super, super important. And there's those little things. And it's good, like see, through your business, you're getting all these reps and interacting with people through like smaller business relationships. That's how you get stronger with anything. There's a podcast, I'm going to forget the name of it, and maybe we kind of put it in the show notes. But basically, the podcast kind of proves out that if you get enough reps in anything, you could get really good at it.
Oh, right? Yeah, so like the 10,000 hours, or I forget what it is.
Yeah, exactly. So there's this woman in Germany, and she's a terrible singer. She's terrible. And she takes all these lessons, and she has this like #1 hit in Germany because she just really worked really hard at it. So I think like hard work and repetition, anyone can get good at anything. It doesn't have to be smart. It's about diligence. So
yeah, that's a good point.
Except for bodybuilding might be different.
Someone had asked me one time about how I got good at underwriting, and I told them when I first started, I didn't really know what I was doing. It was difficult. It felt heavy, but I had like this jar of marbles, and I would put a marble in every time I'd underwrite a deal. Once I had like 100+ marbles in there and the jar got heavy, I was like, that's when I got good at underwriting. I told him just underwrite 100 deals and you'll be solid. So
that's actually really interesting. I didn't know that. I spent like 8 months underwriting and being like, and then like questioning myself and then sending it to someone I trusted. I'm like, am I being an idiot? Can like you look this over? Because I don't know. I also started when
it was like really active market. There was deal after deal after deal after deal every day. There was you could.
Well, you know which ones I learned on? Marcus and Millichap, because they have theirs are so extensive that like I learned on theirs because like they have everything. And then I started doing the ones that didn't have enough information because you have to start somewhere. But Marcus and Millichap actually were the deals that I started underwriting, even if I wasn't interested in the deal, just to get that repetition.
Nick, tell us what's your plans for the next few years? Do you have any big goals for the company?
Yeah, so my goal last year was to get 4 deals done, and I was like, that's too many, But and so I also do kind of the miracle morning, right? So kind of have this morning ritual, manifest things. It's kind of like a prayer, but like you're doing gratitude. So the manifestation works. I was manifesting 4 deals. I missed it. It was 3 deals, but that's too many. So manifesting 2 deals, 1 triple net deal and 1 multifamily deal with one of these bigger capital partners. We're also going to hire our first employee. So this is one of our kind of secret sauces that I'll kind of tell you on the podcast. We've had an internship program for about 3 years, right? So we have undergrads, We have a process, teach them how to underwrite deals. To your point, James, we just throw every single deal at them. Sometimes deals that are kind of old. We actually send them a deal before they start to make sure that they can underwrite and understand it. So we've had this kind of analyst pool for 3 years underwriting deals. But we're going to hire our first employee in 2025, which is pretty exciting because we thought 2024 was going to be the big year of deals. We think 2025 is going to be the big year for doing deals. So anticipation of that and kind of support these capital partners and doing these bigger deals with the bigger capital partners. That's what we're focused on.
What do we call this? We've been saying survive to 25. What do we say now? Is it
there's got to be a new one.
Thrive in 25?
Thrive in 25.
Survive through
Yeah.
25.
Yeah, it's through 25. And then Michael Becker, he says F off in 27 or something when he sells everything.
26 and 27, yeah.
My goal is 2 bigger deals this year, but like I was like getting too many deals and not enough funds, which I think is a lot of people's problems. But then it's like you don't want to spread yourself too thin. So how can you make sure that you choose the deals that make the most sense for you? You know what I mean? Like, what is your usual like buy box?
So it's interesting. I like the A class. I came from A class. A class is very easy, much easier than C class, right? It's the stuff that like we would live in, we can kind of understand it better. And I feel some syndicators make the mistake of like layering in kind of an A class finish on units because that's what they like, but it doesn't necessarily fit with C class.
I grew up in C class, so that's a little different for me.
Okay. Well, then you get, you get it better. But so my capital partners want, and it's unusual that for big billion-dollar companies to want C class, but they understand that there's the higher the yield, the higher the risk, the higher the reward. Generally, I tell them they're from Korea, so they like generally high rises, trophy assets. The worse the property looks, the higher the yield. There's like
pretty much
inverse relationship, right? So we're focused on C class, maybe B class, multifamily in the $20 to $30 million range, eventually maybe bigger, just to kind of get one. We've offered on a few deals with these capital partners. That's kind of the focus. And then on the industrial side, maybe a $5 to $10 million deal. Again, to your point, Alexia, not doing too many deals, focusing on the right deals versus just like trying to get AUM or trying to get so many deals and fees, right?
Yeah, well, it's unique that you're going for the larger Class C. I think that's a smaller buy box for some people. I mean, not smaller box, but it's not as many people are going for those because those are harder to tackle for sure. I mean, you're having
the capital raise, the capital raise. So
these guys that. It's like you have the 100-unit problems, but times 4. So like it's a lot, Yeah,
I mean, the A class is just a different animal, but those are kind of the size assets I would manage. Like I had an asset in Redwood City that was 300 units. That asset was $250 million. That one asset. Wow. So I understand that space, but again, A is so much easier than C. Like the space we're in, there's a reason why the yields are so much higher. So yeah.
So we have time for maybe one more question. What do you typically like to tell viewers or listeners? What's your message to everyone, and then how can they get a hold of you?
So I think we talked about it a little bit. Don't think there's probably a lot of multifamily listeners, but we do other asset classes. But don't think that multifamily is too complicated or too difficult. Like keep listening to podcasts like this. Listen to the Old Capital podcast, one of the best podcasts out there. I have all my analysts listen to that podcast when they're coming in. Continue to do that. So yeah.
Be weird, be yourself, make bad jokes.
Yeah. Listen to the Old Capital podcast. And Nick, you hold a meetup. How can people get on that distribution list, or
and we'll definitely put things in the show notes too for all your links.
So we have a monthly meetup. We just met. We were capitulating because the market has slowed down in multifamily. we were thinking about maybe doing quarterly, whatever. We're just going to continue with the meetup and just not have guests, right? And just have people network. So we do it monthly.
Smart.
We try to do it the third Thursday of the month, except for kind of near the holidays. This quarter, we just want to switch it up a little bit. We're going to have it at Legacy Hall, Legacy West. It's a great venue, second floor. So yeah, and it's a great place because we have experienced people, we have inexperienced people. There's a big syndication group, Revision Masters, John Montero, Merrill Kaiser.
Oh,
they
we
do
love
a lot
them.
of stuff. They're great. They came and spoke at our meetup. They're like, we've probably met 50, I forget what the percentage was, 50 to 75% of our partners at this meetup. You know, and which I think means a lot of LPs. So there's just a lot of relationship building that happens, and it compounds, right? You meet people in their network. You guys are super connectors. You have big networks, right? So you meet someone, you introduce them to someone else. It kind of pays off. I tell my boys, when you give, the universe gives, and when you take, the universe takes. I like to just kind of constantly give because eventually it just kind of comes back. It's karma. I believe in that. And that's what really the meetup does. Like, we thought it was going to bring in a lot of LPs or whatever. Hasn't necessarily done that. It's just brought in a lot of opportunity. It's just an opportunity to kind of give back to some inexperienced people. That's what we love.
Well, I'm the product of that, Nick, by the way. Like, I didn't know anybody in Texas, and I just started going to some of your meetups, and that's how I met John, and we connected because of fitness and things like that. So, and then I started my meetup over here, which I'm restarting soon, but not every third Thursday. But honestly, I think that's it. It's like those connections, and you just find these opportunities, or if you connect people with other people, you just make things happen for them. Even if you don't get anything back, it's like eventually they might remember you, you know, things like that. Or they'll be like, oh, you know, I think this would be a good one for Alexia. And then, you know, they give it back that way. I mean, you never know what kind of connections you'll get. But yeah, your meetup was one of the ones I met a lot of solid people at when I was first trying to meet people here, which is nice.
It is one of the best in DFW.
Yeah. Frisco area, usually.
Yeah. All right, Nick. Well, thank you so much for coming on the podcast, and we look forward to seeing you at your meetup, actually. So thank you again for coming on.
Thanks for having me, guys.
Thanks, Nick.
Have a great one.